Well, it's almost tax time again, and that means it's time to start paying Uncle Sam. It also means the IRS will once again ramp up audits of cannabis business. And when you understand that the average IRS audit of a cannabis company returns nearly 6 times the dollars to the Treasury per hour as the average mainstream business audit, it's easy to see why cannabis businesses are back in the IRS's crosshairs. So in this video, I'm going to talk about the one big mistake to avoid this tax season that can keep more money in your business rather than sending it to the government. So you definitely want to check this one out. Hi folks, Chip Schweiger, the Green Leaf CPA, and I help everyday cannabis entrepreneurs build and grow exceptional businesses using the same growth tips that the big guys use. Welcome to Ask the Green Leaf CPA. So we're in the midst of year end and another tax season is right around the corner. And that means, unfortunately, that Uncle Sam will be looking for his very large share of your money. That's not a political statement about the tax structure in this country, but rather a business statement of fact. Since plant-touching marijuana businesses under Internal Revenue Code Section 280E pay disproportionately higher taxes because you're taxed on gross profit rather than on the net profit of a mainstream business. Not fair, I know, but that's the system we currently have. So I'm going to reveal the one big mistake you need to avoid when it comes to tax time. Hey, before we get started, if you're new to this channel, go ahead and hit that subscribe button and click the bell so that you'll always be the first to get my tips and tricks. Now, there always seems to be bills in the US House to federally legalize cannabis. They all passed the House, I think 8 times now. And before we get too excited though, they've also got to make it through the Senate and be signed by the president, both of which have been uphill battles time and time again. Could be wrong on the next one, could happen all the way, and I hope it does. But I'm not getting my hopes up too much just yet. I'd rather be pleasantly surprised than disappointed once again by the seeming reefer madness that's been going on in Washington for nearly 80 years. And that, my friends, is a political comment. So we've got to assume a few things are going to stay the way that they are for a bit longer and that federal legalization is still a ways off. And that means we're back to taxes and back to 280E. Now, many cannabis businesses have believed that they could minimize their taxes by overstating cost of goods sold. But let me let you in on a little secret. Unfortunately, the IRS knows all the tricks and has been having a field day with companies trying to slide basic business expenses into cost of goods sold. In fact, the tax court is repeatedly ruling in the IRS's favor when cannabis management and their accountants are failing to follow the intended nature of 280E. In fact, just today, we talked with a client about the IRS once again ramping up audits of cannabis businesses. Yes, it seems as though the IRS is emerging from a sort of COVID-induced slumber to once again set their sights on marijuana companies in legal states. Now, the agency has ramped up audits of marijuana businesses, including for cash transaction forms, since last summer in multiple states across the country. Now, when you understand that the average IRS audit of a cannabis company returns over $4,800 per hour to the Treasury, while the average mainstream business audit returns about $600, it's easy to see why cannabis businesses are back in the IRS's crosshairs. Now, this presidential administration has a lot of priorities and a lot of places to spend money and a lot of promises that have been made. So that requires a lot of tax dollars. So the reality is there's no better time to make sure your books are squared away and that you are fully compliant with Section 280E of the federal tax code than right now. And I'll tell you, with fines and penalties that could easily put your cannabis business out of business, this is really not an area to mess around. But if you're thinking there's so much to get right with your taxes that sometimes it's hard to know where to start, well, I hear you. So here's the biggest business mistake I see cannabis companies make when it comes to taxes, and that's commingling or combining THC and non-THC activities in your financial records. One of the most powerful and legal tax strategies we have to mitigate the negative impacts of 280E is segmenting between cannabis and non-cannabis business activities and segmenting between THC and non-THC activities and appropriately segmenting between production and other activities. Now, while typically a cost accounting nuance, segmenting is actually an especially powerful because 280E only applies to THC related entities. So I'm going to show you how to do it because regular business expenses incurred in the non-THC entities are in fact deductible. Now, the essence of this strategy is we want to isolate the THC related activities and stop the bleeding of allocating ordinary business expenses to this entity. And this is one of my personal hot button issues. I think a lot of times cannabis owners think they should take very conservative route when it comes to taxes, and I get it. Hell, I appreciate it. You never get in trouble if you do it this way. But the truth is your obligation and my obligation and all of our obligations is to pay every dime of taxes you legally owe, but not a penny more than that. So it makes sense to look at this so that you don't overpay. Underpaying is bad from a compliance standpoint, and you'll get in trouble for that, but overpaying is bad from a business standpoint. Now, before you get too excited, businesses should be wary of the pendulum swinging too far in either direction. A common strategy I've seen in recent years has been to allocate as many expenses as possible to inventory and then cost of goods sold in the plant touching entity, and then simply dump the rest into the non-cannabis entity. But here's the thing. This is bad accounting, it's super high risk, and will eventually result in massive fines, interest, and penalties from the IRS. So how do you do it the right way? What companies should be doing is correctly developing a methodology in which they identify activities related to the production of high THC cannabis and those of the non-cannabis or low THC. So let me pause for a second. I know it's all cannabis, whether it's marijuana or hemp. But it seems like some folks don't really get it, so let's define the high THC, the Schedule 1 stuff, as cannabis, and everything else as non-cannabis, just for this discussion. Okay, so the first step is that documentation is extremely important in every part of this industry, and when dealing with this, it's even more so. When the inevitable state or federal tax audit comes along, having documented policies and procedures can go a long way in establishing credibility with the auditor. And remember, the non-cannabis entity has got to have economic substance. It's got to be able to stand on its own, and it's got to be managed as a discrete business. So essentially, it's got to be a real company. Now back to the segmentation. Some of the most important assets to segment are your fixed assets as well as your employees, and here's why. Fixed assets are especially important to segment as they often offer very high tax depreciation deductions in the early years of their useful lives. Think of every fixed asset in your company, warehouse and storage center and freezers if you're a processor and transportation and manufacturing equipment. Do you have a documented methodology to separate usage between cannabis and non-cannabis activity? It could mean the difference between claiming larger depreciation deductions or potentially leaving them on the table. So what do I mean? Well, think about it. A company that manufactures both hemp and marijuana vape products in two different entities. So the hemp we'll call the non-cannabis for a minute because they're not subject to 280E. And obviously the marijuana is on Schedule 1 and therefore subject to 280E. As the biomass arrives in the warehouse, it will likely be placed in storage for a number of days. Does the organization have designated THC and non-THC storage centers on site? The manufacturing equipment used to ultimately make the cartridges should also be segmented between THC and non-THC activity. So the non-cannabis divisions would be able to take the tax bonus depreciation, whereas the cannabis division will apply cost accounting to legally move a portion of the annual book depreciation into inventory and then eventually into cost of goods sold as the products are sold. Also consider the trucks that will haul the product off to the customer. If the organization owns and operates the shipping portion, they'll also want to consider the segment strategy for those as well. So does it make sense to have THC and non-THC designated trucks? For businesses that tend to rely on leasing fixed assets instead of purchasing, you should also consider the mixture of how you lease those particular trucks. Now, another important asset for cannabis organizations to segment is their employees. And I know it sounds weird. Employees are the biggest asset to the growth of your cannabis business because they ultimately get your product to market and to your customers. They're also likely the largest cost on your income statement. And so from a cost accounting perspective, their costs should be separated into either direct labor or into indirect labor. Tax-wise, direct labor covers any cost that is directly associated with preparing a product for market. So think factory workers or trimmers and the like. Now, this is good news for a THC entity as it can correctly be allocated to cost of goods sold and thus reduce your taxable income. Indirect labor would be all the other salaries such as back office and admin work and any employee that doesn't directly contribute to the final product. And yes, that includes the accountants. Hopefully you can see why it makes sense to clearly define and segment employees by the cannabis and the non-cannabis activities, and further by the THC and the non-THC activities. Don't let the non-cannabis folks do work on the THC entity because guess what? You've now mixed them together and it's really hard to undo. Labor is often a huge line item expense, so ideally we'd like to get the maximum tax benefit of employing folks. Now in this scenario, consider a small cultivator who grows both hemp and marijuana plants. A typical employee is responsible for the day-to-day growing procedures as well as ultimately packaging the final product for both hemp and for marijuana. Now from a tax perspective, this employee would be 100% direct labor costs, meaning no matter their split between THC and non-THC, we would include all of their salaries and benefits in cost of goods sold and essentially write it off. But consider their manager who inspects and reviews the work of 5 other similar employees. Because the manager's time would fall under indirect labor, we need a methodology to determine how much time they spend on direct production and how much time on other administrative tasks. Now, I'm not suggesting that you take attendance every day, although that could work. Instead, what I recommend is that you give clear direction to your employees as to their job responsibilities and then do a study to determine how much time they're actually spending. And, oh, by the way, having this will help with pricing of your product as well by truly understanding the related costs. Now, from a documentation perspective, well-written and up-to-date job descriptions as well as employee policies and procedures can be key if and when you're audited. This too can greatly assist in responsibly dividing employees' expenses among production, which are going to go into the cost of sales, and other activities, which will remain, as we say, below the line. Taxes in cannabis are extremely complex, and without the right advisors in place, you risk making a huge mistake. A mistake which could result in fines and penalties that can easily put you out of business. Now, I'm not trying to scare you, but just laying out the landscape as it exists until we can get federal legalization. So if you're feeling the least bit uncomfortable, talk to a knowledgeable cannabis accountant and tax advisor. Now, not any tax accountant will do. They've got to understand the very specific rules of the cannabis industry. There's just too much at risk to mess around with this. And if you've got questions about anything related to taxes for cannabis companies, check out my website at www.thegreenleafcpa.com. There's a ton of good stuff there. If you've enjoyed today's video, please give us a like. And if you'd like to see more, hit that subscribe button and click the bell. And if there is anything I missed, go ahead and drop a comment down below. I'd love to hear from you. It just makes these videos that much better when I get to help you with your cannabis business. Now, we drop new episodes each week, so I hope that you join us again. We'll see you.